Hello, everyone, and welcome to today's presentation of Technology Tuesday. My name is Jennifer, and I'm your moderator today. I am in Business Development and Customer Relations here at Out of the Box Technology, and very excited to be a part of Technology Tuesdays. This is a series of free webinars that Out of the Box started several years ago, and we're revamping them again in 2018. And we're really excited to bring different apps, different companies, tips and tricks to people in the industry that are looking for more information or just a little break in their day every other Tuesday. If you're not familiar, Out of the Box Technology specializes in QuickBooks training, integration, hosting, and support. We offer bookkeeping services. We have a couple other things that are a little, as you would imagine, out of the box. We do website design, custom app development, data migrations, and have several franchise services and solutions. We also have two of our own apps. We have our event app, which is a customizable event app. It can incorporate conference registration, multiple events within the app, pretty much your one-stop shop for event apps. We're really excited about our app, Recur 360. It was named one of Intuit's top 10 new apps of 2017, providing advanced solutions for recurring invoices, payments, and collections. Today, I am excited to welcome Jennifer Sanderson, the CPA with Ringler CPA, and she's going to talk to us today about how the new tax reform will impact you the most. And as Jennifer and I were talking earlier, there's so many facets to this tax reform, and definitely not something we can touch on all of it within an hour. But Jennifer's going to do her best to hit some high points that might impact you the most. And who knows, maybe something that becomes a multi-part series, and in a couple months you'll be invited to another session that may touch on a couple different aspects that you find important. So I'm going to go ahead and stop sharing my screen so that Jennifer can take over, and we will get started.
All right, Jennifer, looks like you can see my slides.
Yeah, everything looks great.
All right, great. Well, hello everybody. I'm Jennifer Sanderson, and I'm going to attempt in an hour to talk about tax reform. I can tell you that I've been to many webinars so far and on-site sessions, and it's very unclear, and we've received little IRS guidance yet, so we're going to muddle our way through. I'm going to try to just focus on things that I think you guys should be aware of, but know that there's really no clear-cut answers necessarily yet coming out of the IRS. So I'm going to do my best. I'm certainly welcome to take questions. At the end of my slides is my contact information, so I'm certainly happy to help you. So let's see. First thing is, I'm an associate at Ringler CPA. I'm a long-time practicing licensed certified public accountant. Here at Ringler, I actually met Mike Ringler on a baseball field. He coached my son. So he and I have had a long relationship, but right now while I'm here, I'm in charge pretty much of quality control for both financial statements and tax returns. I am not skilled in QuickBooks. I tell everyone to play in their strengths, and that is not mine. But I'm here to help you guys from a tax reform standpoint. Prior to joining Ringler's, I was a tax principal at a firm called Raymond. We're in the Troy office here in Michigan. And I'm actually a full-time professor at Walsh College. I joined Walsh as a full-time faculty in June of 13. Prior to that, I've been an adjunct at the college since 2006. And while I'm there, I teach both accounting and tax. So I believe a good tax professional is someone that's a good accountant, so they understand what's going through the books before they can give good tax advice. So what we can accomplish today, well, again, like I said in the beginning, to explain all the tax reform, we'll be here forever. And it's just an hour lunch and learn. So what I'm going to do today is try to focus really only on the business provisions. As you know, there was sweeping reform on the individual side as well as the business side. Some of this will touch on the individual taxes, and I have a summary slide at the end of kind of what we as individuals out there should be watching out for. So, but I'm trying to focus really today on businesses and what our clients are going to be dealing with. All right, first one is C corporations. So entities that are functioning as a C corporation with regards to the Internal Revenue Service, their tax rate changed to a flat 21%. This is quite unbelievable, actually. The tax rates for corporations had not changed since President Reagan was president in the 1986 Tax Reform Act. So a lot of people kind of are like, nah, who cares, right? If we're not in big business, it's really not this earth-shattering thing. But I say if we're in small business, I think it's still kind of earth-shattering. And I kind of walk through this simple example. The old system was a graduated rate system. So we started off at 15% and ended up at 34%. So I said in this quick example here, for clients that may have typically kept their income at the 15% bracket, which is a lot of clients here at Ringler CPA, we do still have, some C corporations here. So the owners typically bonused out their earnings to keep themselves in the corporate level to about, $50,000 worth of income. So that same $50,000 in 2017, that tax would have been $7,500 for their C corp. That $50,000 in 2018 will now be $10,500. So what we used to do for simple C corporations has now completely changed. So that is one thing that I think a lot of people out there don't quite understand with this drop in rate for our small businesses. But that's something just I wanted to point out. If you have clients with deferred tax assets or deferred tax liabilities, those are our standard C corporations. Those are going to need to be adjusted. This created a huge, a huge ton of work for the large firms, the big publicly held out there. When President Trump signed the bill on December 22nd, all of the deferred tax accounting needed to be fixed for December 31st, 2017. So it was a huge amount of things to deal with. The FASB gave us some relief out there, but for smaller clients, if you've got deferred tax assets or liabilities out there on your balance sheet and you're not necessarily issuing financial statements, I've got one here at Ringler CPA where we don't issue financials, but we do track deferreds. I'm in the process of getting those adjusted. All right, so that was C corporations. So what's new with pass-through entities? And I'm sure most of you have probably heard of this, is this pass-through entity deduction that's out there. I can tell you there's lots of traps in it, and it's certainly not what I'll say the media has portrayed. I have a lot of clients that are kind of upset, but we're going to walk through this, and hopefully it'll give you some guidance. We're waiting on what I think will be very voluminous regulations from the Department of Treasury and the IRS. This is on their docket to get into, but we have very limited information. So let's just talk about it. First of all, what's a pass-through entity? A pass-through entity right now is going to affect people that are members of a partnership, partners in a partnership or limited liability company, shareholders of an S corporation, and also it can affect people that are operating as a Schedule C. So a sole proprietor, they report everything on their individual income tax return. They're actually considered what's called a pass-through entity for purposes of this legislation. So what happened is they came out with what's called a new deduction called the Qualified Business Income Deduction. You might hear it called the QBID. We always love acronyms in the tax world, so it's the QBID. Okay, from a general ledger perspective, there's no effect. Okay, so for those people that were in manufacturing, the old DPAD has been repealed. So that was the domestic production activities deduction. That is gone in its entirety. The entire Section 199 has been repealed and has been replaced with this pass-through entity deduction, which is Section 199A. I don't want to bore you with code sections, but they are kind of important as we walk through some of this. So for pass-through entities, again, we have no clear guidance yet. And these next few slides are very busy, okay? And I'm not going to sit here and talk through them all. And I have a summary slide, a couple slides ahead, but I wanted to give you the information that is available to us as of today so that you can refer back to it. And if you have clients or you yourself are asking questions about, is this really going to apply to me? and June 15th. Second quarter estimates are coming up quickly. I'm eagerly awaiting a call from a client that is convinced he gets this deduction, but frankly, he's not going to get the deduction. And I'll walk through his example in a little bit. But so what is it? It's qualified trade or business income deduction. 199 cap A is the code section. So first of all, the first bucket we need to walk through is what trade or business are you really involved in? Okay. So I'm going to tell you the trade or businesses this does not apply to are the fields of health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, or any trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its employees. So that takes a whole bunch of people out of this game. So if you have a client that's either a physician or a consultant, they are a pass-through entity, they are not, under current law as it is written today, eligible for this deduction at all. So it will not apply to them. So the leveling of the playing field with the corporate rate dropping to 21% and you being able to take a pass-through entity deduction, that playing field has not been leveled for people that are performing these types of services. One carve-out worthy of noting is if you are an engineer or an architect, this rule doesn't, this exception to the rule does not apply to them. So if you have clients that are engineers, are involved in the field of architecture, they will be eligible for the pass-through entity deduction. So again, very busy slides here, but this slide I'll just tell you, the first thing is you need to be in the qualified business, okay? So let's assume I'm a manufacturer and I'm in an S corporation. The next step is you're going to be eligible for a deduction up to 20% of your qualified business income. But that deduction is going to be limited, okay, to the greater of 50% of your wages, W-2 wages, or the sum of 25% of your wages and 2.5% of your unadjusted basis. So much for tax simplification, friends. This is extremely complex. The service is trying to figure out what this form is going to look like. But this is just the first thing. So if you're in a qualified business, the next thing you're going to have to run into is whether I have paid W-2 wages and whether I have property out there. Okay. What happens though, I'm in a qualified business, I may not have qualified wages. Okay. Overall, the wage and property limitation will not apply for taxpayers who are below the threshold. Question then is, what's the threshold? If I am, I've got a typo here. This should say $157,500. If I am a single taxpayer, not filing jointly, my threshold, my income is $157,500. No matter whether I have a wage or property issue, this is not that limitation is not going to apply to me, and I will be allowed a 20% deduction for my qualified business income. Okay? If my income is $350,000 or more and I am married filing joint, then I fall into the wage or property limitation. So I have a financial services practitioner as a client here, so he helps people with their financial plans and sells insurance. So his point back to me, because he's very close to this $315,000 mark, his point back to me was, I'm not going to slow up my business as, you know, in order to manage my life towards this deduction, which, you know, I'm here to give tax advice, not business advice necessarily, but they sometimes go hand in hand. So I agree, you know, you're not going to slow up your business to keep under this $315,000 threshold. But if we're at year end and we're close to $315,000 and we know we could have some additional deductions for a cash basis taxpayer and take care of some matters, including perhaps purchase of a, you know, new fixed asset, new something that we need in our business, this is something we would want to be mindful about if we're close to these thresholds. So, a very complicated topic. I have just glossed over it for purposes of time and lack of information out there, but here's your quick summary. So I always tell my students that I have it well. So this is your focal point screen, right? Summary 1, are you in a qualified trade or business? If you're a doctor, you're out. If you're an accountant, you're out, right? Basically, if you're a manufacturer or something that's not a consultant, you're in. Is your income below the allowed thresholds? $157,500 if you're single, $315,000 if you're married, filing joint. If not, then the next question is, do you pay wages? And if your wages are low, let's say you're a sole shareholder in an S corporation and your wages are low, or do you pay wages? Do you have property that you're using in your trade or business? That will come into play as well. But it will not make your deduction as lucrative as people think of 20% of your income. So I'll give you my simple example that I have here. I have a guy that, for all intents and purposes, let's call him a salesman. So he is a Schedule C salesman. He makes $1 million a year. That's his net income. And he's sole proprietor, Schedule C. And to him, he makes $1 million a year, but based on what he's heard and read, he is only going to pay tax on $800,000 of that because he should be getting this 20% deduction. Well, first of all, his trade or business is probably one of the carve-outs, okay? Even though he's a salesman, once we dig into that, I think it's really going to be that he's a consultant and it's reputation-driven business, so that will throw him out. And if that doesn't throw him out, okay, because we'll want to carve an argument against that, the next step's going to be is he doesn't pay any wages. He's a single shingle guy. It's him and his car that drive around and got these deals done for his customers. So he has 0 wages. So if he has 0 wages, he's going to have a 0 deduction for this pass-through entity. So a year ago, he paid $1 million, or he made $1 million of income. He's paid tax on $1 million, including self-employment tax. 2018, despite the pass-through entity deduction, he's making $1 million. He's going to pay tax on $1 million, and he's going to pay self-employment tax on that $1 million. There's really no way under the way Section 199 Cap A is written today that he's going to be able to get a deduction here. So I promised him that I would draw a picture for him before the June 15th second quarter estimate, because he's hoping that he gets a lower estimate. And unfortunately, based on everything I've heard to date, I don't think I'm going to be able to do that for him. So that is a quick snapshot, again, of pass-through entities. People out there are going to 1 and 2 day full seminars on this with still not great guidance yet, but we're hoping to get some more information from the IRS before the end of the year. So that is a quick summary of that. Hopefully it's somewhat helpful, at least to know who it doesn't apply to. All right, depreciation. We know that Congress loves to play with depreciation. It's how we play with things in the economy. The laws related to depreciation have become much more generous. Okay, so what does this mean? Although we are much more generous and we can pretty much write off all our stuff. I always caution people is this doesn't mean we can have sloppy books. Okay, so key point on this slide, I think, is we should still capitalize our fixed asset purchases that we have during the year in line with our company's capitalization policy. The IRS, if they come in and audit you, will ask for what your capitalization policy is. Even though we have all these generous deductions out there, they're going to ask for what the capitalization policy is. And if you have a client that gets audited or has a reviewed or compiled financial statement, the outside CPA is probably asking for that information as well. Okay, so what's new? We've known about bonus depreciation. We've known about Section 179. So what's new with the Tax Reform Act? Section 179 is now $1 million. It's never been this high. I think I could actually say ever. It's never been this high. I never like to use those terms in tax law, but I'm pretty confident with this one. As long as if you invest in $2.5 million or less of property, you can write $1 million of that property off. And another keynote with Section 179 is that has significantly been expanded into items of what has been known as real property. So roofs, heating and cooling, fire protection, alarm systems, security systems, all now fall under eligible property for Section 179. That has not been the case before. They've typically been leasehold improvements subject to straight line depreciation in the tax world, or maybe under 15-year depreciation in the tax world. But now they're all in. So Section 179, $1 million. So what if you spend more than $1 million, right? The economy is doing well. You're going to put into place a new factory. You're ramping up your equipment. You're saving money because the tax rate's now 21%, which is all great, and what the motivation was behind this Tax Reform Act. So if you spend more than $2.5 million, bonus depreciation is still out there. Bonus depreciation came into play when after 9/11, and President Bush was trying to spur the economy, and Congress came up with this concept of bonus depreciation. And it's changed over the years. Every tax act typically plays with bonus depreciation a little bit so that we can manage the deficit. But right now, it's 100% for property acquired and placed in service. This backtracks into 2017. So if you have anybody out there that is that hasn't filed their tax returns yet for 2017, this is in play, okay? And it's always been for new property. So when President Bush first signed this bill, I couldn't buy a used piece of equipment. I had to buy a new piece of equipment, okay? So now, though, used property is in game. So if I am, going to buy assets from, let's say I'm a printer, right? I have an old printing client. I'm a printer, and I'm not ready to retire yet, but one of my colleagues in the business that's been a friendly competitor to me has decided to retire and is going to sell me his equipment. So let's say he's got $100,000 worth of equipment there that I'm going to buy from him in an asset purchase. That asset purchase equipment now is I'm going to be able to write off 100% of that equipment. So that's, again, never been able to be done under the bonus depreciation rules. So the term you're going to hear out there is this new to you. So bonus depreciation used to only be original use property, meaning you were the first person to use this property. Now, if it's new to you, bonus depreciation is allowable, 100% of our property acquired. So I say again here, no excuse for sloppy books. If your client does not currently need a GAAP financial statement, they may need one in the future. So I, again, always caution taxpayers, although they can take these write-offs of fixed assets, they want to be really careful and manage their books appropriately, okay? And the other thing is, what we have here in Michigan is this concept of personal property tax, depending on your jurisdiction, okay? Likely you're going to need good records of your fixed assets for personal property tax purposes, depending on your jurisdiction and your state you file in. So again, very generous tax rules, but doesn't mean that we should not be tracking these appropriately within our books. Okay, I'm sure you've heard a lot about meals and entertainment. Okay, so bottom line, friends, expenses incurred for entertainment are not deductible, period. The old law was that it was subject to a 50% exclusion. Today, as of right now, as of the way the statute is actually written, entertainment is not deductible. So I'm here in Detroit, and I'm sure all the businesses here that have bought suites in the Little Caesars Arena, which is our brand new facility here in Detroit, are thrilled that taking their clients to a concert, a Red Wing game, this year a Pistons game, right? Those expenses that they incurred for all of that, not deductible, period. There's been a lot of confusion out there. Some clients are saying, well, I'm just going to put it into my marketing general ledger account. I say we need to be cautious because the IRS is going to know that that's what we're going to try to do with these expenses. So if you typically had $50,000 in entertainment expense in your budget, and all of a sudden your entertainment expense on your general ledger is now zero, as a tax preparer, I certainly will be asking questions as to where that now is. So for any general ledger which has an account called Meals and Entertainment, I highly recommend, and we're going to talk about meals too, I highly recommend that that general ledger account now be broken up and that you have a general ledger account called entertainment. We'll talk about meals as my slides go on. Some exceptions here. If an employer provides entertainment and it is included in the employee's compensation, if a customer pays for his own entertainment, meaning you billed them for it, then you get the deduction. So I say that that's probably not happening out there in the real world, but we do have these exceptions that are sitting there. Unlikely that your client or your employer is going to put that into your W-2. So here is a summary that I pulled off. You know, my students always Google, and I say, why are you using Google when we have great resources in our, you know, online libraries? But this I felt was by far one of the most succinct and clear guidance that I found out on the web. So let's just run through this quickly. Bottom line, meals with clients, customers, or prospects at an entertainment activity, not deductible. Okay, that's the way the rule is written today. You can imagine that people are screaming and yelling, and there may be some changes to this rule, but as of today, not deductible. So if I take my clients to the Tiger game and I buy them some hot dogs, or we have dinner in the Tiger Den, or I buy beer, peanuts, whatever, all the meal consumption while we are at that sporting event, not deductible. Okay, next one, meals with clients, customers, or prospects with substantial business discussions. If that's the case, you're going to be able, we believe, you're going to be able to get 50% of a deduction on that. But I will tell you, I would encourage all of your clients to be very diligent about the documentation related to that meal. So if I take my client out, I'm meeting with the family so that we can begin some estate planning or whatever the story is. I'm going to have a receipt dated May 30th. I had lunch with John and Susie Smith and their kids. I paid for lunch. We were at such and such restaurant, and this was the substantial business discussion we entered into. That documentation needs to exist. A lot like the old entertainment rules where who you took to the game, who was in your skybox, whatever. Those documentation rules we should just take with us into the meals world. If you weren't diligent, I encourage you to be diligent. Meals with clients, customers, or prospects without substantial business discussion, right? For the purpose of goodwill, building client relationships, getting to know people, marketing, right? There's no substantial business discussion happening. Those expenses are not deductible. On-premise meals provided for the convenience of the employer. I love to pick on CPA firms this time of year. During the traditional tax season, I've never worked in a CPA firm where I was not fed well. So if, you know, the employer's bringing in dinners in the evening, Saturday lunches, bagels, whatever, those used to be 100% deductible. Now they've dropped to 50% deductible, and they completely phase out to zero in 2026. So this top one on the next slide is a repeat. So sorry, I'm not great at cutting and pasting into PowerPoint. Meal reimbursements for employees while traveling on business, 50% deductible. Free meals to employees from an on-site dining facility, 50%. And then this one, which got everybody all in an uproar, and they've, you know, we understand it as of this right now. Holiday parties or similar social events for your employees, right? Our holiday party, 100% deductible. Okay, so this is my site. You'll see some of my sites on my slides. So this is where I found this. I thought it was, again, an excellent summary. And I'm sure Jennifer will be able to share my slides with you when we're done with this, if it would be helpful. Okay, so through all that, again, lots of rules. I hope I'm not boring you all to death. So what do I recommend? I'd start setting up some general ledger accounts. One, meals, period. Meals employer provided to employees. Meals, business and travel, okay? So the first two buckets really are subject to 50%, okay? Meals with entertainment, it's gonna be zero, but I put it in a different account. And then employee relations, that would be our holiday, that's probably, I have a lot of clients that have an employee relations account. That's what's sitting in there. That account may very well be established, but that's our holiday parties, our, you know, family picnic in the summer, whatever it is. Employee relations, I would recommend having that account. And then obviously I would have that separate entertainment account, knowing that the client is not going to receive a deduction for that, but I think it should be I think it should be tracked separately. The client all of a sudden, like I said in the beginning, has zero sitting in entertainment, and it had typically been an entertainment type of business where they spend time entertaining their clients or customers, and that's now zero, and marketing or advertising or something else has really spiked. That is going to be scrutinized, I think, by the IRS. Okay, hopefully that was somewhat helpful. Business interest. So another fun topic they're dealing with for tax years beginning after December 31st, 2017, the deduction for business interest may be limited. First caveat here is this rule applies to taxpayers who have average annual gross receipts greater than 25 million. So if you have clients who fall under the 25 million, you can take a little nap. I'll wake you back up in a few slides, but if you have average annual gross receipts greater than 25 million, you're it, okay? And that, when we have an average annual gross receipts tracking system in the Internal Revenue Service, you know, these rules that come out, usually it's a 3-year tracking. So if you're close, you're gonna wanna alert your client that this potential limitation may come into play in the future. Again, not a lot of guidance out there. We do have a notice, though, that the IRS issued related to this. Okay, so who does it apply to? Bottom line, every business, okay? Back in my days at Raymond, I worked in the international world a little bit. I had clients that were either foreign-owned or owned a foreign corporation. We had what was called 163J limitations. So those were interest expense limitations when we were highly leveraged, okay? Bottom line, so, you know, if you weren't in that world, you could ignore any type of interest expense limitation. I'm making a general statement there, okay? Now, though, doesn't matter, okay? Every business, okay? But real estate and farming, right? Real estate and farming can elect out of this limitation, but they've got to change their depreciation, right? So in exchange for getting the interest deduction, they're going to have to mess with their depreciation expense. Old law, again, 163J, very complicated, didn't apply to everybody. Now, it's going to apply to everybody, unless you're in real estate or farming and are willing to give up on some of your depreciation deductions, okay? So what are the thresholds? If interest expense exceeds 30% of your what's called adjusted taxable income, I learned this at a webinar and I agreed with them, this smells like EBITDA, okay? Earnings before interest, taxes, depreciation, and amortization. The excess is not deductible in the current year, okay? Excess is carried forward indefinitely until you utilize it. So I did a couple examples just to kind of explain. So let's say our debt on our books is $1 million and our interest expense, I'm using a 5% rate. I think that's pretty in line with today's economy. Our interest expense is 50 grand. So let's say in the current year, we've got taxable income. We actually have a loss this year of 500 grand, right? We're gonna add back interest expense. We're gonna add back our depreciation because we took advantage of these very generous depreciation rules we have out there. We're gonna add back our amortization, okay? So our adjusted taxable income is a loss of $175,000. So even though I had expense of $50,000 for interest, I cannot deduct it. So my allowable interest expense in the current period is $50,000. So my taxable loss of $500,000 is now $450,000 because I cannot deduct my interest. I will have separate tracking of my net operating loss carry forward, as well as my denied interest expense deduction for the current period. Complicated. Another tracking that we're going to have to do, but for our highly leveraged corporations, I think there's not been a lot of light, in my opinion, shining on this rule that's sitting out here, and I think we're going to have to be careful. Example 2, okay, debt on the books $1 million, interest expense for the current year $500. I've got a tax loss of $100,000, add back my interest, depreciation, and amortization. So I'm sitting at adjusted taxable income. So I'm in income, right? This is the EBITDA concept. So from an EBITDA standpoint, okay, my adjusted taxable income, I've got $225,000. My allowable interest expense, okay, if I take 30% of that, I'm gonna get $67,500. I don't need all of that. I get a $50,000, I'm going to be able to take all of my $50,000 deduction this year. If I had a carry forward, remember we have this indefinite carry forward, the expense we haven't been able to take in the past. If I have that carry forward, I'd be able to use 17.5 of that carry forward this year. Okay, so all of the interest expenses allowed in this example, taxable loss remains at $100,000 with the potential of maybe if I have this interest expense carry forward, I could ramp my tax loss up to $117,500. So not a lot of guidance. It's pretty straightforward, I think. But what I think is not straightforward is I think there's not a lot of taxpayers that are aware of this rule. So you have clients that are involved with venture capital or have a lot of debt on their books. This is going to be, I think, a surprise. So it's certainly not something we're going to want to explain to our client in November or December. We're going to want to make sure they're aware of this as we march through this 2018 year so that we don't have big surprises when we get into year-end tax planning. Okay, cash method of accounting. So for those of you with small clients out there, I tell my students all the time, cash is king. Why would we ever want to be on the accrual basis unless we had to be? So these, again, just like the pass or entity deduction, these are some very busy slides. I apologize. There's lots of rules out there. But I think this is something we need to pay attention to. So old rules. Average annual gross receipts were less than $1 million, but I had inventory. So if we have inventory, we're usually, once we clocked over $1 million, we had to start using the accrual basis accounting. Average annual gross receipts less than $5 million. This is for C corporations, okay? May still need to account for inventory under the accrual method. This is the applicable code sections. These are the old rules, okay? Old rules continue. Average annual gross receipts less than $10 million. These are my pass-throughs, principally service business, okay, and we weren't in mining, manufacturing, wholesale trade, retail trade, or the information industry. We could use the cash method of accounting. Now, sweeping change in my opinion here, and there has been, from what I've seen, no guidance issued from the IRS yet. For tax years, beginning after December 31st, 2017, the cash method may be used by taxpayers, unless you're tax shelter, that satisfy the $25 million gross receipt, regardless of whether they purchase, production, or sale of merchandise in an income-producing factor. So if they've got inventory, they can be cash basis, as long as if their gross receipts are under $25 million. Okay? For tax years beginning after December 31st, 2017, taxpayers that meet the $25 million gross receipts test are not required to account for their inventory under Section 471, which means capitalizing it, okay? But rather, they can use an accounting method for inventory that either, one, treats inventories as non-incidental materials and supplies, or two, conforms to the taxpayer's financial accounting treatment, okay? So I think it's gonna fall under this non-incidental materials and supplies. So this is, in my opinion, a big deal that's changed. Question is now, what do we do? Okay, so this $25 million, oh, side note, before I go to what do we do, this $25 million also applies to small construction contractors, okay? Old law, the contractors were probably required to use a percentage of completion, okay? For tax purposes, unless they were a home builder. New law, if gross receipts are less than $25 million and the taxpayer estimates at the time the contract is entered into that the contract will be completed within 2 years, then the taxpayer can use cash method or a completed contract. Okay? So again, this $25 million threshold carries through on this cash method of accounting. We used to have different ones, 1 million, 10 million, now it's 25 million, whether you have inventory or not. Why does this all matter? If you have a client that has inventory and or a construction business and gross receipts less than 25 million, well, probably over 10 million, so they were forced to switch to the accrual method of accounting under old law. My question is going to be, have they considered cash method, right? This is what we should be talking about our clients this summer, right? Can we go back to the cash method of accounting for tax purposes? So, question is, how are we going to do it? We don't know yet. Okay, the change procedures are pretty complex. When you have to change your accounting method for tax purposes, you have to file a Form 3115. The automatic change rule, that was very easy. If you had to take a client from cash to accrual because you were forced under the 1 million rule or the $10 million rule in the past, it was an automatic change. You attached to your form what's called Form 3115, changed an accounting method to your tax return. You didn't have to wait on consent from the IRS, and away you went. Now, to go from accrual to cash, right? So we've got say a $10 million manufacturer, wants to go back to the cash basis method of accounting. How are we going to do that? We're not sure yet. So we're waiting on guidance. We have a client here that's 1 year into the forced accounting change because of gross receipts and being a wholesaler. What are we going to do? We're not sure yet. We're looking for guidance. I've put out some calls to this, but the service right now is kind of operating under what I'll call a gag order. Until rules are issued, they're really not at liberty to be able to chat with us about this kind of stuff. So we're kind of stuck in waiting. Normally, if you had taken, let's say I took on a new client and they were accrual method, and I was like, why are you under the accrual method? You could still be under cash, okay? Under old rules, let's say it had nothing to do with gross receipts, and I felt comfortable that they could go back from accrual back to the cash method of accounting. That was not an automatic change, so that meant you would have to wait on you would have to pay a user fee and have to wait on IRS consent. So whether we're going to get automatic change here, we don't know yet. The IRS is the Form 3115 instructions still stay as they've been. I've not seen anything. If anybody out there has seen something or been talking about this already with their clients, we're all going to learn from each other as this process moves forward. So, but to me, this is a big deal. Again, if you can be on the cash method of accounting, I highly recommend it from a small business taxpayer standpoint. My students always look at me funny because they're used to doing accounting on the accrual basis. That's what we're teaching them in order to get their CPA license. But I always tell them the story. Why would you pay tax on your accounts receivable, right? If you haven't gotten the money in yet. So then that kind of makes sense to them. All right. Another big thing that's out there, this is really a FASB. The IRS has had to come out and say what they want to do about it, and statutorily Congress did. So ASC Topic 606, the revenue recognition rules, they're for non-public entities. So for public entities, we're there, 2018. They had to get into their, change the method of revenue recognition if they weren't in compliance with ASC Topic 606. For non-public entities, it's going to start in 2019 for calendar year ends. So who does this apply to? Any entity that either enters into contracts with customers to transfer goods or services, or enters into contracts for the transfer of non-financial assets, unless those contracts are within the scope of another standard. So the other standard carve-outs typically are leases and insurance contracts, right? Because they have their whole set of rules. So what are we going to do? How's the IRS dealing with this, right? If for financial statement purposes, a client has to change their accounting for revenue under ASC Topic 606, what does the IRS want you to do? For accrual-based taxpayers with an audited financial statement, okay? If they have audited financials, Section 451 was amended, okay? So basically it's going to allow accrual-based taxpayers to defer the inclusion of income associated with certain advance payments to the end of the tax year following the year of receipt. It's also deferred for financial statement purposes. So in many instances under old tax law, if you had constructive receipt of that money, you were going to have to pick that income up. Now they're going to allow, if you have an audited financial statement, the matching between your audited financial statements and your tax return. So if you receive an advance payment for book purposes, right, we've set up a deferred revenue account, which is sitting in the liability section, and we're going to allow that deferral for tax purposes under Section 451 that the Congress amended. So that's kind of revenue recognition, very general touch on that, but we need to be talking to our clients to see if they have to deal with anything related to ASC Topic 606. And if they do, the big firms out there are already, they're knee deep into this if they've been auditing publicly held clients before. but we need to take practical approach for our small business clients out there. What's the effect going to be? And then what do we have to do for tax purposes? So first rule is, what's our effect going to be under ASC Topic 606? Next step is, now what? Did we really have to change things? And if we did, how are we going to get them changed for tax purposes? All starting 1/1/2019. For those of you that might be aware that the lease rules changed, leasing rules changed as well. Those are not applicable to us yet. I'm focused primarily on stuff that's going to happen in the next year. So the leasing standards changed. I won't scare you with all that. Happy to come back if I'm not driving you all crazy right now to talk about leases when it becomes more applicable. That's also looming out there if you have a client that's involved in a lot of leases. All right, R&E, always a favorite topic of Congress, right? What are we going to do with R&E, or as many people call it R&D expenses, okay? So this is weird that they put this in here, but this was all in about trying to get the bill balanced from a revenue perspective, and watching that deficit that's going to be looming because of this tax cut. So what they've decided is a change pending for years beginning after 2021, okay? So again, very unusual that they put this in the bill when it's not going to be effective till 2022. But R&D expenses will need to be capitalized and amortized over 5 years. Okay, so R&E for GAAP purposes, we expense it, right? Unless you're, there's some specific rules out there, but let's just say for the majority of us, we expense our R&E that we incur for GAAP purposes. Now there's going to be a huge timing difference. Okay, for tax purposes, you're going to have to capitalize that R&E and amortize it over 5 years. What's going to happen with the R&D credit? Don't know. It was not mentioned in this bill, just the capitalization of these costs. Okay. What is interesting that is included in this, and is specifically included, is software development. So I've had multiple clients throughout my career that were involved in software development. And for them, what happens is expenses incurred for software development, interestingly enough, for GAAP purposes, those costs were capitalized and I believe amortized over 3 years. But for tax, we could expense them as incurred, just like old R&E. That rule is going to change. Same thing, December 2021, software development costs for tax purposes are going to have to be capitalized just like they are for GAAP. We're going to get a 5-year write-off, and I think the GAAP is 3 years, but we're going to have a timing difference on that. How am I doing on time? All right, 13 minutes. We're doing okay, I think. But certainly have time for questions if you guys need me. So net operating losses, okay? C corporations with net operating losses, no more carrybacks. Your NOL will go forward indefinitely. This will certainly change how we're going to look at deferred tax assets. And for net operating losses incurred in 2018 moving forward, you're going to have a limitation of how much of your taxable income you can offset. So I'm going to guess a lot of you don't live in the C Corp world, and hopefully many of you are not living in the net operating loss world anymore, or have clients that are currently generating net operating losses. But this 80% offset limit is certainly going to impact this play on taking huge depreciation deductions, driving us into net operating losses, knowing that next year that net operating loss is going to be limited. So 1 year tax planning cannot be looked at without looking at the effect of those huge depreciation deductions and what the impact's going to be next year when I have a net operating loss carryover. So important modeling. We're just, now that we're out of tax season, we're just beginning to set up some templates that are going to help us look at this before we get to year end. I alluded to this before when I talked about the pass-through entity deduction. In exchange for the pass-through entity deduction, we got rid of the domestic production activities deduction. That did apply to pass-through entities if they were manufacturers as well as C corporations. It's gone. Totally repealed as of 1/1/2018. We've had some interesting banter here in the office. We have some fiscal year clients. So the question is, if you are a fiscal year manufacturer, let's say you're an S corporation, you're a fiscal year manufacturer, okay, you're 9/30 year end. So the question we were bantering around about is, are we going to get 9 months of a DPAD deduction and 3 months of the pass-through entity deduction? The sad answer to that is we don't know. The AICPA came out with a great article based on their review of the rules. I'm actually in the tax section of the AICPA, so I got articles that aren't out there for the general public. So basically what their position was, that I think is a fairly conservative position to take, is that if you're a 930S corporation, you're going to be taking the 930-18K1 and putting it on your 2018 tax return as an individual. We're guessing that since in 2018, the domestic production activities deduction has been completely repealed, that that's not going to be available at all, even though technically they were eligible for DPAD from 1/1 to 9/30, old law. We think that when we get to do our 2018 individual income tax return, because DPAD has been repealed in its entirety, they're not going to be eligible for it all. And again, I'm referring to the AICPA article that came out regarding this. So no guidance, we're still waiting. I think we're going to be waiting for a long time. I think the IRS is concerned mostly about getting forms updated right now for the next compliance season, getting us a feel for what the pass-through entity deduction is going to look like, how we deal with transitions, like, and this is a great example between DPAD and the pass-through entity deduction. I think we need to just look at it and make a reasonable estimate and continue to monitor guidance. Okay, employee impact. So some of you may have heard about this, but unreimbursed employee business expenses, okay? For employees that are not reimbursed by their employers for business expense, okay, what happened to them up through 2017 is that they could track those expenses, right? Their mileage, their meals, whatever, you know, if they had things going on, but their employer, small employer, whatever the story was, based on their human resources policies, they didn't reimburse the employees for that, or they were limited, or whatever the story was. The employee then had the opportunity to take that deduction on their individual income tax return as unreimbursed employee business expenses, subject to the 2% floor. Gone. All 2% floor itemized deductions have been removed with the Tax Cuts and Jobs Act. So even if the standard deduction was going to help you or not, right, unreimbursed employee business expenses completely gone under the Tax Cuts and Jobs Act, as well as any other of the deductions that were subject to the 2% floor. Union dues, tax prep fees, investment advisory fees, all of those deductions have been removed, no longer allowed on what I'll call Schedule A for our individual income tax return. That's one key thing that I think affects individuals that people may not be aware of. I have a client that is actually a hair salon, and they were a chair rental business. And the owner has switched them all to being employees, okay, for whatever reason, right? Employers switch them to all being employees instead of chair renters in the business. But the ladies that work at the salon are very immersed in training, and they incur a lot of expenses, and they go to conferences and training, and you know, their supplies, their makeup, their airbrushes, all that stuff, right? That they incur on their own, okay? And they would always take them either as a Schedule C deduction or unreimbursed employee business expense. It's not allowed anymore. So now that they're employees, these expenses are not going to be able to be deductible. So different change on how people are going to have to address this. Change in withholding. If you enjoyed a small increase in your take-home pay, will you have a surprise in April? So the IRS, I have not used this. The IRS actually has, this is the site of a withholding calculator so that you can plug in, especially if you have a spouse that works, whether you're going to be okay in April with, despite the small increase we have, no one is going to want those surprise bills potentially to the Internal Revenue Service next April. So most of us are thinking we're going to be okay, but if you are married filing joint with 2 kids, and maybe those kids aren't old enough for the child credit, which is age 17, but they're in college, I would take a look at this to make sure you're going to be okay. Other things to consider from an individual tax perspective: no more personal exemptions. So those were removed in their entirety. If itemized deductions do not exceed $24,000, that's married filing joint, then you can no longer itemize. State and local taxes, all state, and if you are itemizing, if you're over the $24,000 threshold, state and local tax deduction, all state and local taxes are combined. That's income and property. So your state income tax, if you're in a taxable state like me here in Michigan, okay, all of our state income tax and our property taxes. So that would be our, here in Michigan, it would be our personal property tax on our car and our real estate tax. You combine all of those and the amount exceeds $10,000, which for 2 wage earners and maybe 2 homes or whatever your story is exceeds that. That total amount is going to be capped at $10,000. So you're going to get $10,000 only for a state and local tax deduction. Okay. Again, unreimbursed employee business expenses are no longer deductible. There's no more deduction for moving expenses. There's a lot of tricky rules on moving expenses, but they're out in their entirety. No more deduction for moving expenses. And no more deduction for personal casualty and theft losses. So those fell on to Schedule A itemized deductions, and they're the old law. They've been removed completely unless you live in a federal disaster area. And you have to have been ruled a federal disaster area by the president, or you're not really considered one. You may feel that based on the flood you've had here in whatever state you're in, I know there was terrible weather all over this weekend, unless you were ruled a federal disaster area by the president, it's not a federal disaster area to the Internal Revenue Service. So that was a whirlwind. I hope I did not make you all crazy with some of the rules that are out there. I'm not sure, Jennifer, if people have questions or if we're going to be flooded with questions or people have just decided to go into some other form of business now. But I'm here if you need me.
Thank you so much, Jennifer. That was really, like, I know it was probably the tip of the iceberg, but it was really good, the areas that you were able to touch on. So if anyone who is listening in does have a question, you can go ahead and use the chat, and we will try to answer that as best we can in the last couple minutes we have here. But I do think, like you said, there's a lot of areas that there's still unknowns, and we don't know what the answer is. There's, something new is coming, but in what direction, not sure. So I think that this is certainly an area that we will revisit with 20, who knows, more, whether it's presentations or articles or anything. So we appreciate you, Jennifer, being here to kind of start it all off and, awareness to the fact that there are so many changes happening.
Well, it was my pleasure.
So we'll give it another minute or so here if anyone has a question. Otherwise, we will have a follow-up email to all of you who joined us live, as well as anyone who registered. So if you have a question, we'll have some contact information there. Jennifer, I see you're sharing your slide, to reach out, to Jennifer directly or to any of us at Out of the Box to make sure your questions get answered as best as we can at this point. So yeah, like I said, I don't see any other questions specifically. So
I think I just scared her.
Hopefully not. Maybe their brains are just overloaded. But yeah, so if anyone wants to jot down Jennifer's contact information there, email address, and reach out with any questions. And other than that, I think that will wrap us up for this week's Technology Tuesday. Our next episode is next Tuesday, so we're not going to have a break this time. We have a session next week. Another CPA is joining us to talk about an app on passwords. It's called LastPass. I know we all have so many passwords for different logins, and they all have to include numbers and symbols and all sorts of stuff. And this app is really a great way to generate safe, secure passwords, to store, to remember your passwords, and keep them protected. So if you're available next Tuesday at noon Eastern, we'd love to have you join us. And Jennifer, did you have any other last words you wanted to just say?
No, I mean, I'm here to help you guys. you need anything, or if you want me back to talk about something else when we get more information out of the service.
Great. Thank you so much for that.
And I'd appreciate any feedback. If it was too much, I'm actually presenting again June 19th here locally. So if it's too much or you felt you needed more on something else, please let me know.
Yeah, absolutely. We will do that for sure. Thank you so much.
You're welcome. Have a good day.
You as well.